If you're considering investing in cryptocurrency, it's important to think about how much risk you're willing to take. High-risk investments should only make up a small percentage of your portfolio. And since crypto prices are so volatile, your investment could easily be wiped out in a matter of days. But some advisors and influencers say that cryptocurrencies are still worth investing in. They argue that the technology behind them will be transformative. Risks. Cryptocurrency investments can be a great diversification option for your portfolio. They've been shown to offer high returns and can be a good way to hedge against traditional risks, such as interest rate fluctuations. However, they can be very volatile, so it's important to understand the risks involved before investing. It's important to remember that cryptocurrency is a highly speculative investment, and as such, it's not suitable for everyone. You should only invest money that you can afford to lose. This is especially true if you're new to the market, as prices can fluctuate dramatically in short periods of time. In addition, cryptocurrency is more volatile than other asset classes, so it's important to diversify your portfolio with other types of investments. Another risk is that cryptocurrencies are not backed by any central government or entity, so their value is completely dependent on the ascribed value by other investors and owners. Additionally, they aren't protected by consumer protection laws or bankruptcy regulations. These factors may make cryptocurrencies more susceptible to fraud, phishing, and other security issues. Investors should also be aware of the environmental impact of cryptocurrencies, as the minting process requires a lot of energy. If you're considering investing in a cryptocurrency, it's important to do your research and choose a secure wallet to store your assets. Hacking is a major concern, and cryptocurrencies can't be recovered or reversed in case of theft. It's also important to know that cryptocurrencies are not liquid, meaning they can't be exchanged for cash quickly. In addition, cryptocurrency investing is still a relatively new market, and it's difficult to determine which currencies are the best ones to invest in. Investors should look for currencies with stable price histories, high liquidity, and low fees. They should also avoid coins that are backed by an unprofitable business model or those with unproven technology. As a result of these risks, many investors have steered clear of crypto and are still hesitant to take the leap. But for those who are confident in their ability to mitigate risk and can weather the volatility, the reward could be substantial. Regulations. Cryptocurrencies are volatile investments, and they aren't for the faint of heart. The value of even the most popular coins can go up and down quickly, transactions are irreversible and private, and consumer protections are minimal or non-existent. While some investors have made a fortune with cryptocurrencies, it is important to understand the risks before investing in them. Unlike stocks, which rise and fall based on the company's performance, cryptocurrency prices are driven by speculation. This makes them more susceptible to market chaos and inflation. In addition, cryptocurrency companies are often unregulated and don't have the same business requirements as other financial institutions. As a result, many have gone bankrupt and stolen billions of dollars in investor funds. Cybercriminals have also targeted cryptocurrency exchanges and ICOs, raking in at least $14 billion in 2021 alone. As a new and evolving industry, crypto requires strict regulation to ensure its security and safety. While the Securities and Exchange Commission (SEC) has cracked down on some aspects of the crypto space, including ICOs and insider trading, it is still difficult to establish clear guidelines for crypto investment. Aside from the high risk of fraud, cryptocurrency investing is also a poor fit for many investors' portfolios. Because it is a volatile asset, it's best to keep it limited to a small percentage of your overall portfolio. This way, a gain in the asset can improve your portfolio, but a loss won't jeopardize your entire investment. Additionally, investors should consider the fact that crypto is pretty cryptic and only a few people in the world really understand the technology behind it. This can lead to scams and fraud, so it's best to work with a professional to avoid these problems. We always recommend that you limit your exposure to volatile assets to a percentage of your portfolio that you can afford to lose. If you can't explain your investments to a 10-year-old, you shouldn't invest in them at all. The future of cryptocurrencies is bright, but only for those who can understand the risks. This year's crypto crash burned many investors, but it doesn't mean the technology underlying digital coins won't be transformative in the long run. Taxes. Cryptocurrencies are a relatively new investment, and there are risks associated with them. The price of cryptocurrencies can fluctuate drastically in short periods, and it's important to diversify your portfolio to minimize risk. Moreover, many governments have yet to figure out how to regulate these new assets. Regulatory changes or crackdowns could affect the market in unpredictable ways. Crypto investors must also consider the taxes associated with their investments. Just like other asset types, cryptocurrency trading is taxed as either a capital gain or a form of income. Investors must keep records of all gains and losses and pay taxes when they sell. It's important to consult a tax professional to determine which tax bracket you're in, and to understand the complex rules regarding cryptocurrency taxation. One major appeal of investing in cryptocurrency is the potential for outsized gains on your investment. In addition to this, cryptocurrencies are decentralized, so they're not subject to the inflation that can happen with fiat currencies. Some people also hold crypto as a hedge against the instability of their country's currency. Another advantage of cryptocurrency is its accessibility. Unlike other financial investments, you can invest in crypto from any computer or smartphone with an internet connection. You don't have to go through a credit check or ID verification to open a crypto wallet, which makes it easier and faster to make transactions online. In addition, crypto transactions are secure and private because of public and private keys, proof of work or stake, and other incentive systems. Lastly, crypto investments can be used to generate passive income through a process called staking. This involves using your cryptocurrency to verify transactions on the blockchain protocol. This can give you a return on your investment without buying more cryptocurrency. However, it's important to remember that cryptocurrencies are still speculative investments, and they should never be more than 10% of your overall portfolio. They can lose value quickly, and you may not be able to recover your investment in the event of a crash. It's also important to diversify your investments so you can hedge your risks. Security. Cryptocurrency prices have risen and fallen over the years, and while they can provide high returns, they also carry significant risks. As with any investment, it's important to do your research before you buy anything. It's also helpful to check the background of any exchange you plan to use. This can help you avoid scams and other dangers. One of the most common mistakes people make when investing in crypto is believing that they can always sell their assets for cash. The truth is that most of the time, these transactions are irreversible. This means that if you buy something for too much, or you get caught up in a cryptocurrency craze, you'll probably lose money. Moreover, some of these investments are illiquid, meaning that it's hard to buy or sell them quickly. Another major mistake people make is falling for a rug pull. This is when the founder of a new project invites investors to invest in their project, then runs off with their funds. This has happened many times in the crypto world, and it can be very difficult to recover from. Additionally, most of the time, cryptocurrency transactions are not backed by any government agency or other third party. As such, they are vulnerable to hackers and other cybersecurity issues. Additionally, cryptocurrencies are based on cutting-edge technology, and many of them have not yet been fully tested in real-world applications. As a result, it's important to limit your exposure to volatile investments, such as cryptocurrency, and only invest in them if you can afford to lose the money. Ideally, you should also hold these investments in a diversified portfolio so that a loss doesn't jeopardize your financial future. Fortunately, there are now some options for investors who want to get into crypto without risking their own money. For example, there are stablecoins that are backed by the value of a fiat currency or other assets, and there are also professionally managed cryptocurrency investment funds. These may be a better alternative to buying individual cryptocurrencies, which can be more volatile than stocks and bonds.